Greetings guys, I welcome you in this wonderful video. So we are going to be talking about the MACD, moving average convergence divergence. So I hope we know this indicator, so I'm just going to be sharing with you on how to use it in trading volatility indices or any other market. So I will just delete this window for this video. So here is the moving average, guys. Here on MT5 we have two things. We have the histogram, and then we have this line here, which is the signal line. So we have the histogram and the signal line. So for clarity, guys, for clarity, I will just use the trading view template from binary just to explain a bit of this. So let us just go into it. So I'm just going to be using this chart. So the difference is that there on MT5 we have one line, which is the signal line. We don't have this moving average here. So this is just a basic moving average, so we don't have it on MT5, but it doesn't make any difference. It doesn't make any difference. If you want to have maybe two lines, you can download the MACD indicator, which is customized, not this one which is built in. So it is all over the internet. You can just search MACD indicator for MT5. It is free all over the internet, so you can download it there. But it works the same. The principle is the same, because the main thing here, it is the histogram. It is not these lines, it is the histogram, because these lines, they just say the same thing as the histogram. So I hope that one is clear. So the main thing here is the histogram. When we have the histogram, then we have everything. So let us just get it up and running. So here, what you need to know is that, okay, this tool here, it looks like an oscillator, but it actually works different from an oscillator, because we know that oscillators, they are there to show you some zones of overbought and oversold, né? But this one, it works quite different from oscillators. Why? Because it is a trend indicator, which shows you momentum. Basically, it just shows you momentum. It is a trend indicator that shows you momentum. So that's the difference between it and the other tools that you usually see in the window below. So that's the difference. The MACD, it is a momentum indicator. It is a trend following indicator. So it basically shows you the strength and everything. So I hope that one is clear, guys. For an example, you can see here that I will just talk about the histogram more, because on MT5 we don't have the other line. So I will just talk about the histogram more. So you can see here, basically the histogram was positive. When the histogram is above its zero line here, it is positive, and when it is below, it is negative. So even these lines, they just show you that, because here when the histogram switches from negative going to positive, the lines crosses. Same thing here, they crosses when it shifts from positive to negative. Excuse me. Same thing here, the lines, they just show you what the histogram is doing. So that's why I say it is even efficient, even if you don't have the lines, but they are there to just make it easier in your eyes. So here you can see we had some kind of a transition and then a downward move. So this is where the MACD came in, because you can see that although we can see price moving up in this portion here, but we can see that the momentum in the histogram was going down. You can see that the power in the histogram was going down, which was telling you something, that it is likely that now the market will shift on the downside. It is more like some kind of divergence. That's why it is called MACD convergence divergence. So it's just a tool, guys, that is here to help you with some kind of entries. So let's look even here. So you can see here we have this impulsive long move, but look at the momentum. It started here, it was going up, going up, going up, going up, going up until here. So you as a trader, you're able to observe from here that, okay, we can see that now the negative side is decreasing. It is likely that price is going to go in the opposite side. You see, that's where this corrective came in. So it means that you, as this was playing out, you were now ready for the corrective to come in. So you are able to track when is the corrective going to come, when is the corrective going to kick in, or when is the impulsive going to kick in. So it becomes very, very easier for you because there is this slowdown effect here. Same thing applies here. It goes down, 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 and then all of a sudden that's where you see that, okay, now if it is close to the zero line, it means that I'm about to face a reversal. Same thing applies with this one. If it goes down, 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 down here, you will know that, okay, now I'm ready here to face the opposing direction. If the market is moving up, then I will face the seller's momentum coming in. So that's how you should apply it, guys. Look at here. Look at even this example here. We have this I'm sorry about that. We have this move here, which is like a consolidation or a channel. So we have this channel here, and then there is a breakout, and then prices begin to go down. So look at how it detected that move. So let me just show you here. So it told you that it's now a seller's momentum here, meaning it was able to understand that I can't give you a signal right here on top because there was no clear confirmation. So it has to see how are the sellers coming in the price so that it will give you that signal here. That's why oscillators are going to give you a sell here in this high here, meaning earlier than it here. Oscillators are going to give you a sell, but it is a trend following indicator. That's why it waits for everything to confirm, just like moving averages. It waits for everything to confirm, and then it gives you the right signal using the past or the previous data, combining everything, giving you that kind of signal or trend signal. So it's its signals, they are usually long term. It doesn't just focus on giving you this short move. So it usually gives you even bigger moves, just as you have seen, starting from there going all the way down there. So guys, that's how you should apply it. The moving average, convergence, divergence, also known as the MACD. It is just there to show you momentum coming in or a decrease in momentum. Just apply it, see where you can add it in your strategy or forming a strategy around it. So thank you for watching this video.